In today's video, I'm going to give you some of my favorite index funds in the United States. Now, some of these may have higher dividends than others, but these are all going to be indexes that will cover a large amount of the market. So let's get down and let's check out these amazing ETFs. So, JP Morgan Equity Premium Income ETF, JEPI is the ticker. This is a fantastic ETF. At the first look, we want to look at the MER, and of course it's 0.35. And of course, if you put $100 in as an example, that would mean that every single year you would be giving JP Morgan 35 cents. Now, that is a bit higher than some regular ETFs. However, what you are getting here is some really good growth, but also a 7.5% dividend right now. Now, that is huge. The average volume of this ETF is 440,000 shares traded every single day, which is absolutely amazing. When you go over to the 5-year chart, obviously it's not been around for very long. However, over the past little while anyways, what we can see over roughly 2 years, what we can see is some very, very good growth, and we can see a small little sideways trading action occasionally. However, we do see some nice growth. Now, this could be the fact that it started roughly at the beginning of the whole COVID crisis. However, over this time, it's continued to grow just like the market, which is really good. Now, it does pay a monthly dividend, which is another great bonus to this. So, of course, what we want to try and do is to look at year over year. And year over year, the dividend's actually gone down slightly. That could be from not enough call options being sold, or just a lower dividend in some of the stocks that they're holding. However, basically how you're getting paid a dividend here is partially from dividends from companies, but a large amount of it is from selling covered calls. And the top companies that you would be seeing in this ETF is Alphabet, Target, Accenture, Microsoft, and United Parcel Services, UPS. Some of the notable ones that I really like is UPS. I mentally don't like Microsoft, but as a company I do. And then Target and Alphabet, all great options. And the fund summary is this investment seeks current income while maintaining prospects for capital appreciation. The fund seeks to provide the majority of its returns associated with its primary benchmark, the Standard & Poor's 500 Total Return Index, S&P 500 Index, while exposing investors to less risk through lower volatile and still offering incremental income under normal circumstances. The fund invests at least 80% of its assets in equity securities. It may also invest in other securities not included in the S&P 500. And if you check out their website, it also says that they sell call options. The second ETF is one you've probably heard of before, and that's the SPDR Dow Jones Industrial Average ETF. This is DIA on the stock market. This one does only pay you a 1.6% dividend with an average volume of 3.7 million shares. Its MER is quite low at, of course, 0.16%, and the inception date is since 1998, so it's been around for a very long time. So this one is actually supposed to mirror the market, and as we can see, the Dow Jones, pretty much it does mirror exactly what we see when we look at the Dow Jones. Right now, it's starting to trade a bit sideways. However, it's still very interesting to invest in. How I like to invest in index funds like this one, which I don't currently hold right now, is to buy the dips. Always buy those dips every single time. And then just essentially hold on to the ETF forever. And I like to put at least 10 to 15% of my investments into index funds, mainly because I just like to have the constant growth and the ability to back up and say, well, at least at the very minimum, I'm going to be hopefully matching the market with at least a portion of my investments. So this ETF pays a monthly dividend. And what we're going to do is look at year over year, June to June. So let's try to find June of last year. And we see a lower dividend. Now, a lot of companies have lowered their dividend. We can go back to May and then check out May. but May is also higher. So how I like to look at this is it's not due to the actual companies themselves. It is due to when each company pays their dividend. So what you're going to see is sometimes with these index funds that the main dividend for the main quarterly distributions for some companies may fall a day or two earlier or later, which then will mess up the year-over-year dividend payments. So really definitely don't just check out one single month. Go to multiple months like I just showed you there. Now these are the top companies. Some of the in this ETF, some of these I really do like right now. For example, Salesforce, Caterpillar are some big ones I really like. Goldman Sachs I really like right now. Technically I do like McDonald's, but at the same time I just cannot stand that company and I will never shop there and I will never buy food there. I highly dislike their employee practices. I never worked there, but I know people who have. Next is the Vanguard S&P 500 ETF VOO. Now, I prefer this one over SPY, mainly because of a small percentage point difference in the yield and expense ratio, but overall very similar companies, or ETFs I should say, and you can't go wrong with either one. It's extremely high volume at 3.7 million shares. Of course, SPY is a lot higher of the volume, and I actually like SPY better when it comes to call options if I'm playing the market that way, which could have all played it that way last year around this time and made tons of money, but most of us didn't. And 15% year to date so far is also what the market has done. Essentially, this is supposed to mirror the market. As we can see in the 5-year chart, it is pretty much a mirror image of the stock market itself. Now, this one actually does hold a couple of the stocks, a couple of the holdings in this list right here actually had a small difference of a percentage from SPY, and that's why when I compared these two ETFs before, there's actually a slightly higher growth on VOO, which is kind of odd considering they do have very similar holdings and they have the same goal, which is to match the S&P 500. Now from here we can see that it does pay on this one a quarterly dividend and not a monthly dividend, and it's not bad. Like, you're looking at a pretty standardized dividend. March over March, we can see that of course the dividend has rose. June over June, the dividend has fallen, but we see that with all their similar ETFs as well. Sometimes it's due to, in this case, some of the companies decreasing their dividends because of the virus that's going around, while other companies, due to the way the months and days work out, they'll be paying their dividend in the next a couple days later, which may not line up with the specific months that this one is paying out. And then the last one I'm going to talk about is the Schwab US Broad Market ETF. This is the SCHB is the ticker, and from there it's again going to be mirroring the broader market. It's a 1.4% dividend. However, this one actually has some pretty crazy growth historically. It's got 400,000 average shares traded per day, and it's an extremely low MER of 0.03%. And when we look at the chart, it is very similar to SPY and VOO. However, there is, when you look at the percentage, a slight higher growth with this ETF, which is what I really like. And when you compare it to SPY, this one has a 0.01% difference in the actual MER. So this one's a bit cheaper. This one also does pay a quarterly dividend, and if we look at March over March, we see the slight increase. If we look at June over June, we still see a slight increase as well, which is one of the very few S&P Dow Jones style index funds that actually did increase when it comes to June. I hope that this video is really helping you so far, but really quickly, let's check out the companies that this ETF does hold. This one's holding very tech heavy, very similar to how the market is in the United States. However, this one is very, very similar to an SPY with the percentages, except we're seeing a few of the companies like Alphabet having a slightly higher percentage on this list. I hope that you've enjoyed today's video. If you have, hit that like button and subscribe, and I'll see you guys again next time.